Without a doubt, the big four banks have the largest exposure to both the Australian domestic residential markets, the development and commercial markets, and as such are the best barometers of the market if owners of real estate, based on their capital, should hold, fold, walk away or run. Prior to COVID and amid, we've seen as the cheapest global banking climate experienced in history. This has meant record high levels of liquidity in both the real estate, debt and equity markets, which has put continued upward pressure on pricing for quality assets. As in the Australian domestic residential sector, COVID has created a unique and evolving dynamic in each of the investment grade real estate sectors: commercial, office, retail and industrial. In August 2020 last year, amid the COVID chaos, I spoke with Michael Hynes, the co-principal and founder of Stamford Capital Australia, in relation to the investment grade real estate debt markets and to get a view on the banking outlook. Stamford Capital Australia originate around $1 billion of investment grade loans in the commercial property development sector nationwide in Australia, and as such are an outstanding barometer of the real estate debt markets and investment activity. Whilst there was a collective view that the day of reckoning would come when the JobKeeper and government incentives finished in March this year, together with the close of the COVID-led rental holidays in December last year, the market is holding up across all sectors, buoyed by low interest rates and an increased velocity of domestic spending as a result of the travel restrictions. Michael joins me today to talk through the lending space in the commercial property sectors, both bank and non-bank funding for investment and development, and the effects of the ongoing record liquidity levels. We talk through exposure to various Australian real estate sectors and the re-entry of mezzanine financing to the market. I hope you enjoy the episode. The Property Investment Podcast is brought to you by Golden Goose Capital. Golden Goose Capital has, in conjunction with MP Funds Management, provided funding for over $1.3 billion of investment-grade real estate transactions and provided an investment return of 22% across the board, with the lowest being 9% and the highest being 42%. For more, go to www.goldengoosecapital.com. Mike, thanks for joining me today.
Hey, thanks for having me back.
So let's talk about this time, well, it wasn't this time last year, it was August last year we sat down to have a chat.
Wow.
And it was amid kind of the COVID was sort of alleviating. There'd been a lockdown. We were coming out of the lockdown, then we were back in lockdown. And obviously you guys do about $1 billion of transactions annually in the debt space. So you've got a good view of what's going on from a banking and non-banking perspective.
Yeah.
In the investment grade real estate sectors. What have you seen this year versus last year in terms of the change in volumes of transactions?
Well, it's pretty interesting. I mean, August, I'm surprised. I didn't have the date in my head, but it feels like an absolute lifetime ago. It's incredible when we had that conversation. So, and it feels like we're in a completely different sort of world. Certainly we are in terms of a financing perspective in the real estate market. So I guess we were together August, as you said, the sort of, I don't know, the market felt like it was thawing a little bit. There was some green shoots perhaps emerging. Certainly capital was appearing and looking at transactions, but we didn't really see, I guess, transactional activity start to tick over until probably October, November. So just to your point, our debt origination business in a typical year does a bit over $1 billion of origination. For the financial year 20, we wrote just under 900 million, but we'd written 900 million up until March. So it was literally like someone ripped the handbrake, and that was it. It froze activity essentially for the last 3 months of the financial year. So August, we recalibrated for the new financial year, thinking our volumes would probably sit at somewhere around 60% of usual. So we were sort of thinking we'd do 600 million. As I was saying, we saw activity start to pick up October, November. We had a fairly solid December, and then it just popped at the start of this year. So financial year to date, we've written just under $1 billion already, and we expect we'll probably close out the year at probably somewhere around 1.2, 1.3 billion. which is double what we'd forecast for the financial year. And as I say, that's really all come about since sort of November of last year.
Thanks for tuning in to the first 5 minutes of the Property Investment Podcast. The Property Investment Podcast aims to bring together the best minds in the investment-grade real estate sector. For the full episode and access to the live follow-up webinar, go to the MP Report Premium subscription at www.my-property-report.com.